This is an analysis from Alpha Business Media.
In this analysis, we're going to unpack a critical paradox right at the heart of Nepal's digital revolution. You know the scene. A customer scans a QR code, and just like that, the payment is made. This exact moment happens millions of times a day across the country. And on the surface, well, it looks like progress, right? It's efficient, it's modern, it's financial inclusion in action.
But is it really that simple? You see, hiding just beneath this shiny 21st century veneer is a really profound economic problem. It's a problem that the country's entire fiscal infrastructure is, frankly, struggling to handle.
And this creates a fundamental tension, a real collision course. You've got this high-speed digital economy running head-on into a tax bureaucracy that was built for an analog era.
Okay, let's really dive into this by first looking at the sheer scale of this transformation. Get this. In the fiscal year 2022/23, transactions through QR codes alone shot past 2.1 trillion Nepalese rupees. That is an absolutely staggering increase of nearly 300% in just 1 year.
And here's the core of the issue. While the economy has gone digital at lightning speed, the systems that are meant to collect tax revenue, they were built for a totally different world, a world of paper ledgers and physical cash. They just weren't designed for this new reality.
So how does this incredible growth actually end up weakening the state's finances? Well, it all comes down to how these millions of daily transactions are classified and how that classification makes them, for all intents and purposes, completely invisible. So here's what you need to know. There are really two types of transactions happening. First, you have a business payment, or C2B. That's business revenue, and it should theoretically be taxed. But then you have personal transfers, or P2P. Think of it like paying a friend back for lunch. It's just a personal transfer, and it's totally invisible to the tax authorities.
And this is the heart of the problem. The huge majority of small merchants, from the tea shop on your corner to an online store you follow on Instagram, they simply use a personal QR code for business. What does this do? It makes all of their business income look exactly like a personal P2P transfer.
So for a tax system that has no real-time access to this data, that income, it basically doesn't exist. It just vanishes. The result is a digital gray market with an estimated 2 trillion rupees flowing through it every single year, completely untaxed.
Now, it's important to understand this isn't necessarily about people trying to break the law. It's a rational economic calculation. For hundreds of thousands of these tiny businesses, the hassle of formal registration and filing taxes seems way more costly than the very small risk of getting caught. Being informally digital has simply become the smartest business decision.
So what about the state's response to this massive digital leak? Well, it's been tragically inadequate. The tools the Inland Revenue Department is using are just completely mismatched for this challenge. It really is like bringing a bow and arrow to a drone fight.
You see, their policies, like mandatory digital invoicing, only apply to businesses that are already in the tax system. They have tracking systems for physical goods, but those are completely blind to the booming digital services economy. And all their databases are siloed. They can't even talk to each other. The whole strategy is just to squeeze more from the few who are already paying taxes, instead of widening the net to include everyone else.
All these tools, they were designed for a 1990s economy, not for today's digital world. And it all points to one thing, a massive, gaping hole in the country's underlying infrastructure, which brings us to our next point.
To really get what's missing, let's just look south to India. Their UPI system is praised all over the world, and it shows us the critical piece of the puzzle. You see, India's success isn't just about the payment app on your phone. It's about the deeply integrated, three-layered stack behind it that links a person's identity, their bank account, and their tax ID together.
And that's the sobering lesson here. Nepal has enthusiastically copied the easy part, the slick, user-friendly payment app that everyone loves to use. But it completely neglected to build the difficult, complex, and absolutely essential institutional architecture underneath. In essence, what's happened is that Nepal has built this beautiful, attractive shop front, but it forgot to build the warehouse and the accounting office. And a structural problem of this magnitude, well, it demands a structural solution.
And that brings us to the concept of a central bank digital currency, or a CBDC. Now, this isn't just another e-wallet or payment app. A CBDC is fundamentally different. It's a digital rupee, a direct liability of the central bank, just like a physical banknote in your pocket. You can think of it as public monetary plumbing.
So what's the big deal? Well, its power lies in its design.
Imagine a world where a transaction could be automatically identified as a business payment, and at that very moment, a small final tax, let's say 0.5%, is instantly sent to the government, right at the point of sale.
And here's where it gets truly transformative. For that small merchant, tax compliance suddenly becomes the default setting. It's automatic. This could completely eliminate complex filing, get rid of the fear of audits, and basically remove the biggest barriers to joining the formal economy. You'd be shifting the entire paradigm from voluntary declaration to automated collection.
So Nepal really is at a crossroads. Adopting a CBDC is definitely not simple, but let's be clear, the alternative is far, far more dangerous. It's a choice between intelligent design on one side and fiscal decay on the other.
On the one hand, yes, CBDC has real challenges. You have to address privacy concerns, improve digital literacy, and you'll face resistance from existing players. These are significant hurdles, for sure, but they are manageable design problems. They can be solved. But on the other hand, the crisis of just doing nothing is so much worse. We're talking about a collapsing tax base, an unfair burden on the few who are actually compliant, and skyrocketing public debt. This isn't just a design problem anymore. This is an existential crisis.
Because ultimately, doing nothing leads to a future where the state simply cannot fund basic public services because its entire economy has become digitally invisible. So the conversation really needs to shift and shift fast. We need to stop asking if a CBDC is needed and start asking how we can design one that actually works for Nepal.
Because the future of Nepal's economic reform isn't waiting around for a new tax code. It's waiting for new monetary plumbing.